Hello, everyone. This is Steve Gorin, and thank you for attending today's webinar, Fiduciary Income Tax Refresher and Update 2023. I have with me my partner, Laura Duncan, who's also one of our practice group leaders. Before we begin, we want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email if we get around to it. You can also just email us too. And you can see our emails at the bottom of the slide deck. A copy of today's slide deck is available in the resource widget. For technical materials supporting the slides, please see the link to my newsletter also in the resource widget. We encourage you to download any resources or links you may find useful. So in my newsletter, you'll see about midway through, you'll see a yellow box that has a link to the most recent version of my big PDF by Business Structuring Materials, which is about 28 megabytes. So that's why it's attached that way. You can find additional answers to some common technical issues located in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 hours of general CLE credit, and in Missouri for 1.8 hours of general CLE credit. The webinar is also CLE accredited in New York for 1.5 hours of experienced and transition credit. 1.5 hours of general CLE credit in Texas is pending. We award CLE based on attendance for the entire 90 minutes. Due to changes in jurisdictional requirements, you will notice that we are no longer using automated pop-up attendance checks. As required, we will display secret words in 3 multiple choice polls during the webinar. You will be required to select today's secret word from a multiple choice list. Please respond to these 3 polls to demonstrate your continued engagement and to earn your full CLE credit. We value your opinions and appreciate your participation in the course. Okay, so going through the materials, I did tell you how to download the big PDF, and the slides, we have much more than we could cover in an hour and a half. So some of it is just for reference there for you. But I do have instructions here on how to navigate between the slides and the big PDF. And if you want to try to do both of those, fine. But also, everybody will get a link to a recording of this. So if you want to go back, you'll be able to take the link to the recording and pause it, and then you can go back and forth between the slides and the big PDF at that point. All right, we're going to talk about strategic income tax planning, documentation to avoid the multiple trust rule, state fiduciary income taxation, discretionary distributions in the first 65 days of a taxable year, including how to carry out capital gain. We'll also talk about minimizing liability for the trustee and the tax return preparer, and tax issues regarding trust termination.
Okay, we're going to start today by talking about some tips for fiduciary income tax preparers. And I will just mention, as Steve said, that there's parentheticals on most of these slides. So on this slide here, it references 2J4. So if you go to the bigger material, there'll be a lot more information about the topics we're going to cover today. So it's a good reference material for you as well. So the tips for our fiduciary income tax preparers, just some high-level things to think about as we're starting to prepare fiduciary income tax returns for 2022. And we've got some items listed here to think about as we're working on those. So the first one, possible change in a beneficiary's residence, which could change the posture of a trust from a resident to a non-resident trust. Distributions after year-end to carry out income. So that would be the 65-day rule we're talking about, and potentially carrying out capital gains, which we're going to talk about capital gain elections. Charitable distributions that can be made this year and count as distributions made last year. making a trust a partial grantor trust as to a beneficiary. And this would be a permanent shift of income from the trust to the beneficiary. Moving on, how to make a trust a complete grantor trust as to a beneficiary. Again, this would be a permanent shift. Sorry, going back here for a second. Trapping income in a trust notwithstanding distributions. So we're going to talk about an ESBT or an ESBIT, which would allow trapping the trust income inside the trust. Modifying a trust to make it more income tax efficient. There's some relatively new tools in our toolbox for modifying trusts. So decanting is one of them, doing modifications under the Uniform Trust Code, things like that. Material participation for business or rental activities, and this is where we're going to talk about the NEAT tax, which applies to passive income. And then helping our trustees provide annual notices to beneficiaries to reduce the trustees' exposure. So again, in that material, we have some sample notices that can be provided. And what we're trying to do, obviously, is to shorten the time that the trustee can be sued. The key really is adequately disclosing the information and giving notice to the beneficiary, indicating the time allowed to commence a proceeding. So moving on to how we help a trustee provide annual notices. Generally, trustees are liable for 5 years after the termination of the trust, so we can potentially cut that to a 1-year liability time period. So if you have litigious beneficiaries, they have to complain obviously sooner rather than later. Or if you have happy beneficiaries, it's a good time to give them notice and hopefully they're not going to complain about anything. So again, we have some sample notices in the material. We typically provide these records in a flash drive with a table of contents and send those out. And you can be very helpful to the trustee in how to establish sort of a platform for doing this every year and getting the statute going.
And just to reinforce for the litigious beneficiaries, if you only have 1 or 2 years of exposure, then there's not much incentive for a plaintiff's lawyer to get involved for a contingent fee. So that's what really cuts it down is that you know they're not going to get a contingent lawyer compared to if you have 20 years of exposure, there may be a lot more at stake, and so the contingent fee lawyer may be more interested. Okay, so for an estate and a non-grantor trust, of course, you compute the taxable income. Initially, the tentative taxable income is called distributable net income and D&I, and that is to whatever the D&I is actually distributed or required to be distributed is taxable to the recipient, and the estate or trust is taxed on the rest. And there's a link to a very basic summary fiduciary income taxation in that last bullet point.
So in 2017, there were some changes in the tax laws, as you all know, which provided some significant issues for us to deal with now. One of those is that miscellaneous itemized deductions are no longer deductible through the end of 2025. So under 67E, trust administrative expenses are fully deductible as the regulations provide. And basically, these are expenses that would not have been incurred if the property had not been held in the trust, or to say it more positively, it's expenses incurred because you have a trust or estate that's the taxpayer at issue. And the SALT deduction, that state tax deduction, has separate $10,000 limitations for beneficiaries and non-grantor trusts. So that is something else to take into consideration. We do note that property taxes, unlike the income taxes, are unlimited for trades and businesses or rental real estate. So obviously you can still get a lot of mileage out of property tax deductions for trades and businesses. Couple other changes just to note briefly for electing small business trusts or SBITs. They can now have non-resident aliens as permissible current beneficiaries. And also SBIT deductions for charitable contributions on a K-1 from an S corporation now apply the code section 177 instead of 642C. And that's significant when we're going to talk about excess losses, which we're going to talk about next. So planning for excess losses. So generally, trusts cannot pass losses through to beneficiaries except in the year of termination. And section 642 talks about what those deductions are. And 642H1 provides for the carryover losses. And H2 says excess deductions carry out into termination, but don't define what kind of deductions those are, which until 2020, and we had some regulations, that was problematic because the regs had treated those excess deductions as miscellaneous itemized deductions, which, as we mentioned, are disallowed through 2025. So the 2020 regulations were very helpful because they allowed us to classify excess deductions on termination in one of three categories. Basically, the most favorable being allowable in arriving at adjusted gross income or above the line deductions. Secondly is non-miscellaneous itemized deductions, or third is miscellaneous itemized deductions. So most favorable at the top, least favorable at the bottom. And basically what the regulation said is the deductions retain the same character as it had in the hands of the trust or estate. So you look at what would the characterization be for the trust or estate, and then when it's carried out to the beneficiary, it would be the same sort of deduction. So these final regs provided that deductions are allocable to income items. You can choose which deductions offset income. So the plan would be to use those less favorable deductions first to offset trust income, which is the equivalent of deducting itemized deductions above the line. So we're going to give a few examples here just real quickly on how that can be useful. So if we have a terminating trust that has $5,000 of income, $2,000 of tax prep fees, and $4,000 of legal fees, you can see that we have $1,000 of excess deductions that we can carry out to the beneficiary. Both of those types of deductions, the tax prep fees and legal fees, are 67E above the line deductions. So when they carry out that $1,000 to the beneficiary, it would also be an above the line deduction in the hands of the beneficiary under the 2020 regs. Previously, that would have been a miscellaneous itemized deduction and unusable by the beneficiary. So if we have the same example, but the $4,000 in legal fees is replaced by $4,000 in state income tax, which is an itemized deduction, we still have an excess of $1,000, but this is where we talk about using those bad deductions first. So when we prepare the tax return, you choose to apply $1,000 of the $2,000 in tax prep fees and all of the $4,000 of state income tax to eliminate the $5,000 of income. That leaves our $1,000 excess deduction as a $1,000 above the line deduction carried out to the beneficiary. If instead we had offset the income by $2,000 or all of the tax fees, but only $3,000 of the $4,000 in state income taxes, that would leave $1,000 in state income taxes left over to carry out. That would be a regular itemized deduction carrying out to the beneficiary. So you can see that the variation one is better. We get $1,000 above the line deduction that carries out to the beneficiary. So this is, again, just as a tip for fiduciary income tax preparers. Now we have these 2020 regs, and we can use these deductions a lot more favorably in terms of deciding which ones to apply at the trust level and which ones can carry out to the beneficiary in the year of the trust termination. So the final regs, again, just to say that they are consistent with the 642H2 personal exemption and charitable deduction are not excess deductions. So those do not carry out. And as I mentioned before, the SBIT's charitable contributions are now considered Section 170 deductions. So they do carry out to the beneficiaries as opposed to those 642C deductions. And we just put in here the regulations with the applicable dates. The proposed regulations can be relied on for 2018 and after. So it just might be worth considering going back and looking at those prior year tax returns and see if it's worth doing any amendments to those returns to potentially carry out those excess deductions to the beneficiaries, which previously would have been treated as disallowed miscellaneous itemized deductions. So we come to our first secret word of the day.
So today's first secret word is tax. Please select the correct word below. Okay, so now we're going to go on to the next part, and we're going to talk about the deduction for qualified business income. And the deduction for qualified business income, 20% of qualified business income. There's a bunch of rules for it. What you might get none, part, or all of it if you satisfy those rules or don't satisfy the rules. And if you're below certain taxable income thresholds, then you get the full deduction. So go ahead and look at those deductions, and or at least that's for your reference. So when it comes to this deduction, grantor trusts are disregarded, and all the elements that go into this qualified business income deduction are attributed to their deemed owners. Now, if you don't have a grantor trust, what you do is you see how much D&I got distributed to the beneficiaries and how much D&I was retained by the trust. And then you use those same proportions to allocate the qualified business income, the wages, and the UBIA. The deduction is not included in calculating D&I, and the taxable income thresholds are applied separately at the trust and beneficiary level. So rental real estate, there is a rental real estate safe harbor. That rental real estate safe harbor is useless for just about everybody. It would knock out most large shopping centers and large office buildings, but they don't need the safe harbor anyway because you have a business. So I really basically think that you're just not going to be using that safe harbor. If you want to go into details on it, you'll see a link there at the bottom of slide 27 to a webinar that I did, and the first part of the webinar talks about that safe harbor for rental real estate in more detail. Okay, multiple trust rule. So if you have more than one trust and they have the same grantors, the same beneficiaries, and a principal purpose is avoiding federal income tax, then the IRS can collapse them, and the rules are very confusing, to say the least. Act text comments point out the various questions that remain based on the statute and legislative history. So I'll let you go through those at your leisure. But here's just kind of the takeaway, which is go ahead and document the non-tax reasons for the multiple trusts. I mean, if you have a trust for son and a trust for daughter, and maybe a trust for all descendants. I mean, the trust for son and the trust for daughter are separated out because each of them may have their own goals, and you don't want to have them fighting over investment goals and distributions. And on the other hand, you also might want to have something that's more of a family-based thing for everybody, So that might be why you might have the sprinkle trust for everybody. So it could only take, a sentence or two or three to write that down, and then you'll have the documentation if the IRS ever comes knocking and you're concerned about that rule.
And clearly, we can think about a lot of non-tax reasons why we would want to have different trusts for different descendants, et cetera. So it shouldn't be too difficult to come up with some really good reasons why you would want to do planning that way. So we're going to move on to some strategic income tax planning, and these are some of the issues we're going to cover here. Who is best taxed on gross income, the effect of kiddie tax rates, who benefits most from deductions, state and local income tax ramifications, considering trust purposes when we're talking about income tax planning, the effect on future years, such as capital gain elections, grantor trust powers, things like that, flexibility in trust income taxation, planning for excess losses, which we've talked about a little bit, and the Code 645 election. So talking first about who is best taxed on gross income, I think generally we kind of have a bias maybe that we assume that it is better for the beneficiary to be taxed on a trust income. And in many cases that may be true, but there's more than just two factors to consider than just saying who has a better rate. And so on this slide, we talk about some of the things you might want to consider in determining which way to go on that issue. So increasing a beneficiary's AGI can cause some other complications, such as reductions in particular itemized deductions, such as medical deductions and casualty losses. Those are reduced as AGI increases. The phase out of the AMT exemption for the beneficiary, a phase out of the personal exemption starting in 2026 and going forward, and the effects of net investment income tax, or the NEAT tax. So once an individual's income exceeds certain threshold, the NEAT tax applies. However, the individual's thresholds are much higher than a trust thresholds, which we're going to talk about in a little bit. Also would want to look at what the beneficiary's loss carryovers are, so that could be used to offset capital income. And then thinking about, is the beneficiary in a top bracket, it could effectively have a lower rate because income is offset by those losses. So the effect of the kiddie tax rate, so the Secure Act changed what we had before, which under the Tax Cuts and Jobs Act, it had taxed the child's income at the trust rates, but now we're back to kind of what the old rules were, which is the child's unearned income is taxed at the parents' rates. But there is no rule coordinating the NEAT tax, so there are separate thresholds for children. So shifting income to children could still result in tax savings, even if you have the kiddie tax apply. The next thing you might want to look at is who benefits most from deductions. So Steve's going to talk about that.
Okay, so administrative expenses are allowed above the line, but are temporarily disallowed for beneficiaries. So for example, if you had tax prep fees, tax preparation fees are fully deductible by a trust, but an individual cannot deduct them because those are miscellaneous itemized deductions. Those miscellaneous itemized deductions are disallowed until the end of 2025. So state tax deduction as well. The trust has its own limits. Beneficiary has their own limits. So having the state income tax paid by the trust may be beneficial to have more state income tax deduction. We'll talk about charitable deductions later. There's also a special rule for depreciation deductions that allows depreciation deductions to get passed through to an individual, even if that's like a loss. So that's an unusual rule. State and local income tax. So I have a bunch of slides on it coming up. We look at the trust rates versus the beneficiaries rates. So, for example, if we had a New York trust and it had a beneficiary in Florida, of course, the New York trust would be taxed at a pretty high rate if the income gets carried out to the individual and his portfolio income, then they wouldn't have to pay tax at all, or vice versa. If you had a Florida trust with a New York beneficiary, then you might want to keep that income inside the trust to avoid income taxation. And also, if you have a grantor trust, then like an irrevocable grantor trust, and then later on you want to turn it off so it's no longer an irrevocable grantor trust, that most states will take the position that when you turn it off, the grantor trust status, that's when you test whether the trust is a resident, and you look at the grantor's beneficiary at that time. So an example would be if I had an irrevocable grantor trust created by a Missouri client, and the client moved to Florida, and then they turned off the grantor trust status while they're in Florida, well, then it's not going to be a Missouri tax trust because the settlor was in Florida at the time it became a non-grantor trust. I have a bunch of other slides here talking about the limits of state fiduciary income taxation, and I'm not going to really get into all the details here. Each state goes into it differently, and the slides kind of go through some of the considerations. And the Supreme Court, in the one case that it looked at it, kind of decided a bit off more than it can chew, and issued an extremely narrow ruling, which doesn't even apply to all trusts in that state. So I don't want to get too excited about going over all of these things because it's in the materials. And by the way, there is a wonderful B&A income tax management portfolio written by Richard Nino, and I do have in my big PDF in the part on state and fiduciary income taxation a link to a very brief overview by Dick, and so you'll be able to look, if you want to look at various states and you don't want to go to the B&A right away, you can have that summary. But I certainly would encourage going to that B&A. One of the things to consider here is that when you have a trust that's a non-resident trust, there may be some income from a pass-through that's taxed in another state. So there's this Minnesota case called Fielding, where the trust was not a Minnesota resident, but the trust did hold stock in an S corp, and the S corp had some Minnesota source income, and so Minnesota, of course, taxed that business income, which you're allowed to do for non-residents. You can tax their business income that's located in your state, and Minnesota decided it wanted to tax the rest of the trust income too, because once it got its hooks into the trust, they wanted to expand those hooks. And the Minnesota Supreme Court said, no way. That's a totally different thing. You're only going to get taxed on the business income. There's another case called Lynn. And basically the idea here is that each year you have to look to what states have contact with the trust during that taxable year. In the Lynn case, we had a case that was fully an Illinois trust, and they were able to convert that to a trust that had totally Texas law, totally Texas contacts, no more Illinois contacts. And the Illinois Court of Appeals held that just because it started off as an Illinois trust didn't mean it was always going to be an Illinois trust. So you can consider decanting to move a trust out of state. And Another point, okay, is the sale of a business. So when a pass-through business sells its assets, the owners are taxed wherever the assets are located. On the other hand, let's suppose you have, and by the way, let me just kind of point out, if you have an S corporation, the buyer wants to get an inside basis step up on the S corporation's assets. So normally they will do an election to tax that sale, and this is right up on this slide here, to tax the sale as if it were a deemed sale of the S corporation's assets, followed by a liquidation of the S corp. So when you do that, then each state that had the assets in it is going to get their mitts on part of those sale proceeds. Now, let's suppose you have a partnership interest and you sell the partnership interest. You don't have to do this deemed sale of the assets in order to get an inside basis step up. All you have to do is make a 754 election, and that'll give you an inside basis step up when you sell the partnership interest. And in that case, you don't have a deemed asset sale, so the various states don't get their mitts on it. It's only where the owner's situs is located that you have tax on that. At least that's the way current law in most states reads. And again, the materials discuss this a little bit more. Okay, so that's all I'm going to cover on state income tax for now. Oh, I went over and did some of your stuff. Sorry. Okie dokie.
I think the point is on the state income tax, just to kind of summarize, that state income tax is a big issue. I think it's something that tax preparers sometimes overlook a little bit, don't pay enough attention to, whether you have a resident trust, a non-resident trust, and it can have significant implications on trust income taxation. So just a reminder to look at those issues very carefully. And we're going to talk about some ways that you can change the tax posture of a trust by decanting. As you saw in that Lynn case, that was the way that they escaped Illinois taxation, both by changing it over to a Texas trust. So there are some ways that you can change the state income tax posturing of trusts and make it beneficial. So we're going to move on to considering trust purposes. So are distributions to the beneficiaries to shift income appropriate? That's kind of what we're looking at here. So some of the non-tax reasons to think about are listed up here: protecting a beneficiary from third parties, such as creditors, spouses, ex-spouses, government; protecting the beneficiary from him or herself. So if you have a spendthrift beneficiary, you really need to think about whether it makes sense to make distributions out to that beneficiary, even if it would save taxes. And then avoiding estate taxes at the beneficiary's death. So now that we have a significantly large exemption, that may not be as big of an issue, but as things stand right now, we will be going back to a smaller estate tax exemption in 2026. So we're going to talk about capital gain elections and the effects on future years, and how distributions in the very first year of the trust, when you make a principal distribution, could have a permanent effect on capital gain taxation and how that carries out to the beneficiary. And also turning on and off grantor trust powers can affect future years. So you may have a swap power or other powers within the trust that make it a grantor trust that could be released in future years and cause it not to be a grantor trust any longer. So some thoughts on flexibility in trust income taxation, thinking about how we're drafting our trusts, how do we make them as flexible as possible for the trust income tax posturing? So if we have a support standard, which is clearly an ascertainable standard, there's ways to potentially make that more flexible by requiring or not requiring the trustee to consider other resources. We typically allow our trustees to consider other resources, but they're not required to do so. So that gives the trustee some flexibility in making distributions for support. And also look to whether the trust provides for a welfare distribution, which obviously is much broader than a support standard, and also the 5% withdrawal right that would potentially make the trust a partial grantor trust as to the beneficiary with respect to that lapsing withdrawal right.
Yeah, and this one I put in as a stray. I should have put it with the other part. So you can't pass through losses other than the depreciation, and when you do have depreciation that you pass through, the rules are kind of uncertain as to whether you look at the trustee's participation or the beneficiary's participation. You lose excess losses except in the final year, or net operating losses or capital losses still get carried forward from year to year. So year to year, net operating losses and capital losses keep going, and you don't lose them, and then the final year they can get carried out. And the passive loss rules might simplify some of these issues in that if you don't have if the losses are suspended and you don't have any losses to go up against your income yet, then you're just suspending those losses and carrying them forward anyway.
And then the Section 645 election, which is used pretty often now, which is the election to treat a revocable trust as an estate, has some clear benefits in most situations, not every situation, but in many situations it can be beneficial in that you just have one tax return for a trust in a state as opposed to two tax returns. But it also gives a trust some of the benefits that's currently allowable only to estates, which is choosing a fiscal year, the charitable set aside, and an extended time to hold S corporation stock. And just one note on the fiscal year election, it is nice because it can allow the shifting of income from one year to the next year, but it does add some administrative costs and expenses because obviously our 1099s are key to a calendar year. So if you do a 645 election, it terminates depending on, the time frame depends on whether you have filed an estate tax return or not for the decedent. If you did not file an estate tax return, then it terminates 2 years after the decedent's death. If you did file an estate tax return, then it's 12 months after the closing letter. And we're going to go on to our next secret word, which our secret word is
income. So please select it below. So while you're answering the question, we had a question: can prior year's returns be amended to take excess deductions as above the line deductions? And the answer is yes. If the statute of limitations is open, you can do that. So it's getting toward the end of the period where that
you're going to run out
the
of
law
time.
changed.
Yeah.
Yes. All right, go ahead, Laura.
Okay. So we're going to talk about distributions after year end to carry out income to the beneficiary. So this is the time of year, now we're in February, to be starting to work on our fiduciary income tax returns because this is when we can do some planning. And one of those big planning potentials is the 65-day rule, which is mentioned on here. So until March 6th, you can make a distribution in 2023 and treat it as a 2022 distribution. And that's the way that you can carry out capital gains to a beneficiaries. And we're going to talk a little bit about that in a few minutes when we talk about our capital gain elections. And so when you file the return, you can decide how much of that to count for 2023 versus 2022. So This is our capital gain election. This is it.
All righty. So tax preparation software traps capital gains unless you take special steps. We're going to talk about strategic issues first, and then the law and some practical issues. So additional 5% capital gain rate, you can see what brackets there are, and the fact that trusts get that additional 5% capital gain rate at a much quicker pace. Furthermore, the zero capital gain rate, and I just have the 2023 up there. I don't have the 2022 up there, but you can see that the rates for an individual you have a lot more you can capture capital gain at a zero rate than you do at the trust level. And then our 3.8% tax on net investment income, which of course, as Laura said, we pronounced that and so you can see the rates there. So the rates are definitely higher for capital gains that are trapped inside a trust. Now, the code actually says that capital gain is going to be included in D&I unless it's excluded. That's the title of my slide. Okay, the code says that. People think the presumption is that you're going to trap capital gains, but the presumption under the code is it's D&I unless it's excluded. So when does the code exclude it? The code says that only if it's from the sale of a capital asset and allocated to corpus, and it didn't go out to the beneficiary, and it's not used for charitable purposes. So all four of those conditions have to exist in order for it not to be in D&I. And now the sale from a capital asset is here's a really weird thing. So let's suppose you have a building that's used in a business. Suppose you have $100 million building, and you've got lots of tenants, and so it's definitely an office rental business, etc. So that's a trader business, and any property that's used in a trader business is not considered to be a capital asset. That's right. You put $100 million of capital into this building, and it is not a capital asset. That is how weird our income tax system is. But Code Section 1231 says that when you sell that office building, then the gain on the sale of the real estate component is going to be capital gain. So that is capital gain from something that's not the sale of a capital asset. So Code Section 1231 gain is automatically going to be a capital asset that gets into D&I. Okay, so now here are the three different ways that you can carry out capital gain from the sale of a capital asset. And most people focus on number 2, allocated to corpus but not distributed consistently. But the regulation says number 1 or number 2 or number 3. So if you made a bad permanent election under number 2, no problem. You can be under number 1 or number 3. So you need to learn each of the 3 of these. And
so in other words, if you missed number 2 in your first year, you still have the options of using 1 or 3.
Yep. Okay, now you can exercise the power to adjust to let capital gain be counted as part of income. And I have some background material on that in the slides, and we have the Uniform Principal Income Act power to adjust, and the Uniform Fiduciary Income and Principal Act, which 2018 the Uniform Law Commission adopted. It's only been adopted in a few states, and I strongly encourage you to adopt UFIPA in your state because it's easier to exercise the power to adjust to get capital gains allocated to income. Okay, and so we got all the different factors. I'm not going to spend all the time going through all those factors. Converting to unit trust, we also have those factors, and again, you can read those at your leisure. So the bottom line is a trust agreement can allocate capital gain to income, but the regulations do not let you depart fundamentally from traditional principles of income and principal. And 3 to 5% should be okay. So what you would do is you would take the value of the trust and multiply it by, for example, 5%. And so let's say, for example, you had $1 million trust. So 5% of $1 million is $50,000. So if you had $20,000 of dividends and interest, then you could push out $30,000 of capital gains using that power to adjust and still be within a reasonable range. So that's you don't have, that's not an absolute limit, but it is a good general rule of thumb. Oh, and by the way, under this first one, once you allocate to income, you still have flexibility as to whether it's included in D&I or not. The regulations do not require you to be consistent to how much you do. So you can, each year kind of set your limit by that. The second one, so that was the first exception or way to pull it out. The second one is allocated to corpus but distributed consistently. So the first year in which the trust has capital gains that are allocated to principal and the trust distributes principal, you are making an irrevocable election for that. And generally, to me, I don't want to make an irrevocable election, and I don't want to rely on an irrevocable election. I just want to be flexible. So normally I would try in that first year to document that we made the election not to carry it out under that one, and that we might have relied on a different method, either the number one, the allocated to income, or number three, the actual deemed distribution. So all you have to do is put it in your trust records. There's no fancy election to put on the return. So just put in the work papers for the fiduciary income tax return or the trustee's record somehow that you decide to rely on number one or number three, and that you are not electing number two. Okay, so number three was the actual or deemed distribution. So tracing the actual distribution generally is not practical. Of course, in the final year, by definition, you know that all the capital gains earned in the final year are passed out, since everything in the trust got passed out. But the regulation says that you utilize the capital gains in making the distribution decision. So all you got to do is have a record put something in the trust records, maybe an email between the trustee and the CPA, and maybe also an email to the beneficiary saying, we are using capital gain to make this distribution. And you can be inconsistent from one year to the next. So there's a ton of flexibility to push out capital gains. And there is a question, there's one or two questions in there. I'm going to wait till the polling questions to actually answer that. So we're going to move on to Laura talking about fairness issues.
Okay. So talking about fairness issues and whether it's fair to tax a beneficiary when they're asking for a distribution for a particular purpose. They might be upset that they've asked for this distribution and now they're being taxed on it. So one way to deal with that is to gross up the distribution for the taxes to be paid. And that gross up can still result in overall tax savings to the trust. So are distributions advisable? We would look at, are distributions even available based on the trust provisions? And we talked a little bit about support and welfare and the protective nature of the trust. Would we be undermining some of the non-tax reasons for keeping or not making a distribution to a beneficiary because of some of these non-tax reasons? So are distributions available? Again, looking at the trust instrument itself, do you have a support distribution standard, a welfare distribution standard, both potentially, and how those can be utilized, and considering or not considering other resources? So think about what your trust agreement should say and how to make them potentially as flexible as possible. And again, we often allow the trustee's discretion to consider, but not require them to consider other resources. And then other tax issues other than income taxes, the estate tax on the beneficiary's estate, So are distributions increasing a beneficiary's estate that would be subject to estate taxes? And that might be a good thing, because if an asset is included in the beneficiary's estate, it would get a step up in basis for income tax purposes. So again, other non-income tax reasons, but tax reasons to think about distributions to a beneficiary. And the protective nature of the trust. Again, there's other reasons. Obviously, we have trusts that satisfy real world needs of our beneficiaries and how to protect them. So are we looking at some of those, and are some of those reasons important for why we might not want to make a distribution out? So creditor issues, spendthrift issues, saving for another day, but beneficiaries could have creditors down the road.
Okay, so another way to try to provide for capital gains to be considered trust accounting income is you can form a partnership. And so you would start off with the trust being the general partner of the partnership, and the beneficiary be a limited partnership, and would be a limited partner. And then what happens is that any cash distributions from the partnership represent trust accounting income. So if the partnership has, interest, dividends, and also capital gains, and you're distributing cash out, then you can carry out capital gains as income when you make a cash distribution from the partnership into the trust. And the other thing that you can do, if you want to push out capital gains to the beneficiaries, you could give the beneficiary a limited partner interest. So number one, distributing the limited partner interest out to the beneficiary itself is a distribution, and the basis of that partnership interest will carry out D&I. And then also, as a limited partner, the beneficiary will get allocated income from the partnership, and the limited partnership interest is just a piece of paper, so they're not going to be able to spend that at all. And you can have restrictions on assignment, et cetera. And then the other thing is that as the general partner, the trustee can control the distribution. So giving that limited partnership interest isn't going to cause there to be a big cash distribution that wasn't helpful. So if you do use a distribution of partnership interest to carry out the capital gain, then they won't have cash to pay their taxes yet. So you're going to need to accompany that with some cash to be able to pay their taxes on it. Okay, Laura?
So when we're drafting trusts, what are our ideal trust provisions? And I think the bottom line here is as much flexibility as possible. So even with the support distribution, is there ways that we could make that more flexible? One thing that we use sometimes is reasonable support and comfort, which we consider to be a broader standard than just saying support, where it's a support obligation payment. So that is approved by the regulations, that you could use something that creates some broadness in terms of a support standard. You could have an independent trustee with a welfare distribution power. So obviously we don't want to cause unnecessary inclusion in a beneficiary's estate. So you could have an independent trustee appointed who's not a related or subordinate party who could make the welfare distribution. And also consider a 5% withdrawal right, which would make the trust a partial grantor trustus to a beneficiary. But the 5% could also be turned off potentially by the trustee or a trust protector if the beneficiary had creditor issues down the road. So again, on the welfare, having a non-related or subordinate party under 672C, welfare distributions can be very useful, or welfare standard, can be very useful. If you want to try to carry out capital gain, you might be limited if you want to make a distribution and you only have a support standard. So this is where welfare can be very helpful. And also welfare standards may allow you to decant into another trust. And decanting, again, is is the trustee's ability to move or change trust provisions, either by moving it to a new trust or essentially modifying the provisions of a trust under state law. And then also considering charitable distributions. So charitable deductions for a state or a non-grantor trust reduces adjusted gross income. It's the exclusive way for charitable deductions to reduce net investment income that is subject to the NEAT tax. It is more liberal than the 65-day rule. So if a contribution is made during this calendar year of 2023, it can count as a 2022 contribution. It must come from gross income, though. A charitable contribution must come out of gross income to be deductible.
And what that means is you make it after you earn the gross income. You don't have to actually trace the dollars, but it needs to be done after you earn the gross income. So I would recommend making the charitable distributions either at the end of the calendar year or even the following year, and make your special election to backtrack.
Treat it as the previous year. Yes. Okay. So our third secret word is adjust. Adjust.
Okay, while we're running the poll, we'll answer some questions here. Can you use the 65-day rule to pay out gain from the sale of a 1231 asset? And the answer is yes, very much so. Now, what if you have a capital gain through a K1 and you don't know what your K1 items are going to be? And that could be capital gain or anything else. We don't know what our K1 income is going to be. So in that case, what you do is you take your best shot, but when in doubt, err in hire of a higher distribution, because later on in the year, when you go and do your tax return, and you look to see, how much is going to be great to have a distribution for 2022 and how much you want to keep in 2023, you have total flexibility when you prepare that return, even on extension, total flexibility to allocate those January 1st to March 6th distributions as 2023 or 2022. But you can only do it for distributions that were actually made. So if you just distribute more, then you have a larger pool to use to figure out how much is 2022 and how much is 2023. So that's the way I would handle when you have K1s that are going to provide unknown numbers when to do your tax planning. Okay, so it looks like we've had almost everybody submit the poll. So now we're going on to the next one, Laura.
So just briefly again, it's important to look at the beneficiary's residence. And every year we should be verifying each beneficiary's residence and not just assuming that they are still the same place they were the previous years, because this can have a significant impact on our state income taxes. So for example, in Missouri, the trust has to have at least one Missouri resident beneficiary to be considered a resident trust. And that's a snapshot on the last day of the year. So if we had somebody move, we may not have a Missouri resident beneficiary anymore on the last day of the year. And as Steve mentioned before, if you have non-business income, it's typically not taxed to a non-resident's trust. So this could be a big impact on the trust on whether it owes state income tax or not, depending on the beneficiary's residence.
Okay, so material participation for business or rental activities. So first of all, if you have business income and it's passive, then that will subject you to net investment income tax. And so if it's inside the trust, you're going to be looking to the trustee's participation. So you'll want to document the trustee's participation. Now, even if the trust is taxed to the deemed owner under the grantor trust rules, you ought to consider having the trustee participate, which we'll discuss in a moment. And I mentioned already about the excess loss, the depreciation passing through to the beneficiary. And so, we don't know whether the trustee's participation or the beneficiary's participation will trigger that be considered to be active. And so you take whatever position you think is going to work the best. But back up to this idea about the net investment income tax. So, people normally, when they think about the passive loss rules, they think about material participation being more than 500 hours. But for passive income, the passive loss rules have a special significant participation rule that says if you have net income, we will count you as being active if you work just more than 100 hours. So it takes over 100 hours to avoid net investment income tax, but over 500 hours to avoid the passive loss rules in terms of deducting a loss. So there is a big difference between those two. And so just think about that when you're doing your planning. So when we go to the next slide, if you have a qualified subchapter S trust, the beneficiary is taxed as the deemed owner of the S corporation stock, except for the gain on the sale of the stock or the business assets. So in that case, you're looking to the deemed owner, so you look to see the beneficiary's participation in the S corporation's activity. But if you're selling the business, then the issue is what about how does that get taxed? And the answer is when a QSST sells the S corp stock, that is taxed to the trust instead of to the beneficiary. So on the next slide, you see that we've got a little chart here that if the QSST is selling the stock, the IRS's position is that the trustee needs to materially participate. Now, the trustee, basically the trust was not a non-grantor trust until the sale actually occurs. So how, for that instant of time, the trustee can work 100 hours is a little bit unknown. Maybe the IRS expects you to do some kind of a time warp. I'm not quite sure. Or maybe they'll count the trustee's work while the beneficiary was the deemed owner, which is a more reasonable view of that. But an even more reasonable view would be to look at to let you use the beneficiary's participation. And AgTech wrote some comments suggesting that, but we'll see what happens. So then we're going to move on to the next part, which is making a trust, a partial grantor trust, as to a beneficiary. And this is particularly powerful now after the Secure Act. So under the Secure Act, we have generally no more than 10 years to distribute an inherited IRA. And then getting that trapped inside the trust will basically have very high rates applying to the IRA income. And so of course, you can distribute that all out to the beneficiary, but is there an in-between strategy that you might use? So here's the in-between strategy. So you exercise discretion to declare a distribution. So let's suppose we have our support standard, which, by the way, in our document, support is the shorthand for health, education, maintenance, and support. And so let's suppose the trustee says, okay, beneficiary, I think that it would be reasonable to distribute $100,000 to you. Now, I'm not going to distribute that until you tell me you want it. So I've exercised my discretion. I'm telling you, you can withdraw this $100,000 at any time. And then the beneficiary can decide whether to withdraw it or not. But the trustee is basically saying to the beneficiary, I don't have any more discretion anymore. I exercised it. This is absolutely your right. So that's called crediting a distribution. And those of you who've looked at fiduciary income tax returns, it says paid, credited, or required to be distributed. And you might say, why are they talking, what's this credited thing? And this is exactly what that is. So when you have the crediting, let's suppose the beneficiary does not take that distribution that year. So then will that absolute right lapse? What I would tend to do is follow the same strategy as a hanging crummy power, for those of you who are familiar with those. For those who are not familiar with them, just read the materials. I kind of go through this. But the idea is that the lapse of the withdrawal right, you can take the position that makes it a beneficiary deemed owned trust for a portion of the trust. So you can convert your trust to being partially deemed owned by the beneficiary, so you can automatically get some income shifted to the beneficiary. So it's a good idea in some ways, but on the other hand, you can't turn it off once you've turned it on. So you know, you do need to take it with a grain of salt. So then on the next slide, I talk about an article I wrote that kind of goes over the next few steps here, and I don't think that these that this is the be all and end all. I think there's a lot of issues with the exit strategy that concern me. So I'm not doing this for everybody, and in fact, I'm rarely, if ever, recommending it. But when you want to think outside the box, you know, here's an option to think about. So on the next slide, we talk about how the strategy works. The trustee contributes the assets to the S corporation, and then the trust converts to a QSST. And now, if this is discretionary trust, and now it's mandatory income, so you're kind of increasing the beneficiary's rights. Depending on now you also can have, you know, the beneficiary would then do the QSST election, but the trustee can later convert it to an ESBT. We'll talk about that in a minute. So on the next slide is the requirements for QSST. All income must be distributed annually to the sole beneficiary. Nobody can get principal other than during the beneficiary's lifetime, other than the beneficiary. Now, that first bullet point is a year-by-year test. That third bullet point applies to the whole lifetime of the trust. So if you convert a trust to QSST, then you can never go back in terms of they're the only person who can benefit during their life. But you don't have to have the income turn on the whole time. You can later make it be an ESBT. And Laura was going to talk about this some more.
So an ESBT is trapping income in a trust. So regardless of whether we make distributions or not, the income is trapped in the trust. ESBTs are useful because they're a lot more flexible in terms of how you structure those, which we're going to talk about in a second. But you can, again, turn off the ESBT election. So you can potentially toggle between an ESBT and a QSST, but you have to be very careful about what the provisions of your trust are to make sure that they qualify for both.
So the ESBT, if you were not a former QSST, it can be a sprinkled trust. All the S corp income is taxed at the highest bracket, and you have limited deductions. And then on the next slide, we talk about flexible trust design, and so I would tend to, for a spouse, I would tend to instead just do a Q-typable trust, unless you toggle between QSST and ESBT as appropriate. Now, one of the big issues for S corps, people are kind of like, well, how long after a person dies can you hold the S stock before having to make a particular election? And I submit to you that even though that's an important question, that's not the most important question. The most important question is, if you keep it in that trust after the grantor dies, so like you have your revocable trust, and the grantor dies, if you keep it in that revocable trust, you may be trapping that S corporation income at the highest tax bracket. So if you have a married person who dies and they're leaving everything to their spouse, go ahead and put it into the marital deduction trust ASAP. And you can do your portability return, of course, and then you can start getting everything taxed at the surviving spouse's tax bracket. That's going to be a lot more favorable income tax wise for a lot of people. Not everybody, not for your super rich, but when you have your moderately wealthy people, it could make a big difference. Okay, let's go on to the next slide and talk about flexible trust design for children. So at the drafting stage, you can make it be flexible, but have only one beneficiary to the trust, and you can have a lot of different flexible provisions in the trust, and you could even modify the ESPT and split it into one or more QSSTs. So you might have, multiple trusts, one of which will give you you can have a QSST that can get you your run from the brackets, and then any excess beyond that, you keep it inside an ESPT, and that way you can accumulate and save the money, and in terms of all of your wealth accumulation goals. Okay, so then on the next slide, another thing to consider is whether, if you have an ESPT, whether that might distribute its income into another trust for the same beneficiary, and with the idea that you hold reinvestment distributions in the separate investment trust, and the distributions from the S corporation trust will not carry out the income, because they're just simply all the S corporation trust has is ESPT, and ESPTs don't carry out income. So that may be a strategy. I've done that for a client to save state income tax. The trust was a non-resident trust, so it's not paying any state income tax at all, and the beneficiary was receiving distributions. So she got the distribution from the ESPT, and whatever the ESPT was going to reinvest, it reinvested in a separate trust, and then that separate trust income did not get carried out to her because she wasn't getting distributions from that trust. Now, I don't know whether that will work for federal income tax purposes under the multiple trust rules. In this case, we were doing it to save state income tax, so the federal multiple trust rules would not apply. Okay, then finally, if you are toggling between QSST and ESPT, the first time you toggle, there's no time restrictions. But if you flip between one and the other already, and you're going to want to flip again, you got to wait for 36 months.
Okay, we just wanted to talk a minute about modifying trust. So we've talked about a lot of different strategies we can use, but what if our trust doesn't have those provisions in it that allow us to do some of these things? What can be done? So up here are a few different ideas. We can do a trust modification under the Uniform Trust Code, depending on your state law. So the settlor and the beneficiaries get together and they agree to a modification that can make your trust more income tax effective. Decanting, as we talked about in that Lynn case, that's what the strategy they used, where the trustee was able to decant to a new trust with different provisions that made it more income tax effective. And in that case, it was changing the state connections and eliminated state income tax ramifications. The other possibility too, which is not up here, is the use of a trust protector. And we are using those more and more in our trusts. And a lot of states such as Missouri are codifying trust protector rules. So in many trusts we have trust protector provisions where a trustee can appoint a trust protector or somebody is identified as a trust protector, and they are able to modify administrative and other provisions of the trust, which could help you make changes depending on what your circumstances are and how they've changed over time. So those are some ideas on ways when you want to look at your trust and it doesn't have what you need, what can you do about it?
Okay, so the final segment is final year income tax traps. So, and this was inspired by an article that Jonathan Blotmacher and a few other people wrote, and you'll see in that 2J4 HII, a reference to their article. So an estate may have substantial gain from satisfying pecuniary bequests. So let's suppose somebody's entitled to $100,000 cash bequest, and you satisfy that with appreciated stock because it went up between date of death and the date of funding. And of course, not necessarily this year would that have happened, but anyway, the gain on funding that pecuniary bequest is going to be taxable to the estate and not to the recipient of the pecuniary bequest. And the specific bequest also does not carry out income. So again, if somebody just had a $100,000 cash bequest, you distribute $100,000 to them, and you use some of the trust income to make that distribution, that income still gets trapped inside the trust, because as a recipient of specific bequest, they're not going to get deemed with income. Code section 663A mentions that if it's either 1, 2, or 3 payments, that will not carry out the income. Okay. Then also, non-deductible expenses may exceed income. Well, claims against an estate, that's not really an expense, but that's still an expenditure. Same with mortgages. State death taxes are another expenditure, and that's not deductible. Administrative expenses may be deducted on the estate tax return, the state's tax return, in other words, the 706, instead of on the income tax return. So then you might wind up being subject to income tax on what's in the estate, and maybe you don't have the cash to pay it because you've already paid those administrative expenses. So going on, expenses are deductible for regular tax, might not be deductible for your net investment income tax, and so you may incur the tax, and even though there might not be an ordinary income tax, so you just need to think about that. I already mentioned the depreciation may pass directly to beneficiaries. If the client was to terminate by year end, be sure to have the accounting fee, all the fees prepaid, so they're deducted on the final return. Now, if the tax preparer overshoots a little, that's fine. So let's suppose the tax preparer charged, $5,000, and then when they prepare the tax return, it winds up that they only their bill only was $4,000. So they gave a $1,000 refund. Well, when they prepare the return, they would just deduct the $4,000, and that $1,000 they can just simply give back over to the beneficiaries. So when in doubt, err in favor of having higher fees. So just like we would err in favor of having higher deductions, and then you can always do the refund. Excess loss that we already went over, so that's covered not below but above. Final year, so another thing is just note that the executor is personally liable if they distribute assets before paying the estate's or trust taxes. So that applies to income taxes as well as estate taxes. And think about the decedent's final income tax return. That can also attract an IRS audit and liability. So the executor or the trustee, the revocable trustee, need to be very careful about holding on to assets as a contingency. Now, from an income tax or gift tax viewpoint, Form 4810 will cut short the statute of limitations for the IRS to audit returns. So I do recommend, generally that you file that form, and it's done shortly after that return gets filed. You need to give the IRS a little bit of time to process the return, but of course, if it's electronically filed, then it's going to be a pretty quick turnaround. All right, so on the next one, so be careful to reserve enough cash to defend an audit. so that you can pay any tax, interest, and penalties that might be due. When you're terminating the trust for income tax purposes to do your final year return, if you retain a cash reserve, that does not prevent the estate or trust from terminating for income tax purposes. So the regulations allow you to have a reasonable reserve to still count as terminating. Now, I would tend to suggest keeping the reserves in a non-interest bearing account so that you don't have any further tax return filing requirements. Finally, I think you should have a release and refunding agreement. So the release is where the beneficiaries say, trustee, we've seen everything you've done. We agree not to sue you. And that's important because a trustee can use the money of the trust to defend himself or herself if they get sued. But once they let loose the money, if they get sued later, they won't have the money there to defend themselves. So getting the release when you're making the distribution can be important. Now, a refunding agreement, the idea is to have the beneficiaries agree that if there's any of these other things that come up, that I've already mentioned, that they will pay the money back to the estate or back, so the estate can go ahead and pay those liabilities. But of course, it's one thing to have a legal requirement, but it's another thing to collect on that. So
hard to get the toothpaste back in the tube.
Yes, it sure is. And the other cliche, a bird in the hand is worth two in the bush, right? And it's cardinal season coming up, so we're really thinking about those birds. So anyway, so the refunding agreement is really more of a backstop. It's not really what you're mainly going to be relying on. So then on the final slide, and then after that, we're going to answer a bunch of questions during our time remaining. So on the final slide, just the resources, the newsletter that's in the widget, you can subscribe to that to get quarterly updates to the big PDF. We have other free resources. And then anybody who's a CPA, there's my CPA Academy webinar page. I have some free CPE that's available. So let's go on. I'm going to answer, we'll answer as many questions as we can get to here. But before I go to the questions, I want to make sure that everybody will complete and submit the survey that we'll display at the conclusion of the webinar. So I'm going to we'll answer questions probably like until 1/2 the hour. And then those of you who want to leave can leave. And if we have questions that remain, we'll spend another few minutes to answer those after the 1/2 hour passes. Okay, so let's see. Somebody asked, in the case of a complex trust with no distributions made to the beneficiaries, do we need to calculate the trust accounting income on the tax return? Well, there's a box for it, so
yeah.
I would do that.
B, but
Yep.
Yeah.
I don't know if you fail to fill out the box what the consequence is.
Yeah. Most tax prep software does that automatically for you and would fill in that number.
Yeah, and then you can also do a diagnostic on it to see how the number
how it's calculated.
was calculated. So on the partnership topic, what creates the trust accounting income? The distribution of cash from the partnership is what creates the trust accounting income. So the K1 generates what are your taxable items. So that the K1 generates your distributable net income, and the cash creates your trust accounting income. There's a question about would Form 1041 Cap A be used in connection with charitable deductions, and the answer is generally no. If you really delve into the weeds on it, the Form 1041 Cap A is for somebody that has an ongoing permanent charitable interest, and so there's more requirements to it. So I wouldn't do it just just for some. It really all depends on the trust. Question, what if grantor dies, trust continues to hold personal residence, and it takes the beneficiaries a longer time to take personal property and residence for sale? Can the utilities and other things be deductible now because you're preserving the residence as part of the trust? And I think the answer is anybody living there? If nobody's living there and you're just holding it to be able to get it ready to sell, then I would take those expenses as a deduction to keep your property, make it ready for the
Right.
sale.
It's preserving a trust asset, basically.
And furthermore, when you have your commissions on the sale and other closing expenses, if they're to the extent they're allocated to the seller, they can generate a deductible capital loss. So yeah, there's the personal residence can be very helpful. So does cottage savings apply to both trust decantings and modifications? So that's in my big PDF in 2J, I think it was 18, somewhere around there. And so the bottom line for that is you need to think about whether somebody is losing like fixed and determinable rights. So if you have a mandatory income right in the original trust and you have a discretionary right in the remaining trust, well, now there may be some kind of a trade going on here where the beneficiary has given up that income right and they haven't sued the trustee. I mean, if the beneficiary is stripped of the income right and they don't complain about it and try to get it back, they may have made it some kind of a taxable gift, and there might have been some kind of a taxable exchange. There are rulings all over the place on income tax consequences to modifying trust, but you'll see where I covered decantings and mergers and divisions, and the very end of that, I cite an income tax regulation, and it basically asks, how set were the beneficiary's rights? If you had a good way to ascertain the value of their rights, and they gave up those ascertainable rights, then you may have an income tax consequence. But if it's all discretionary, so suppose the trustee had the ability to distribute income and principal for welfare, so nobody had, and it's a sprinkle, nobody had any rights whatsoever, then when you move it over to the next trust, they didn't give up any rights because they didn't have any to begin with. So then there would not be an income tax event. Okay, somebody asked about, what about a delayed specific bequest paid over a period of time? So again, if it really was just one bequest, it was supposed to be paid at once, and the trustee didn't follow what the document said, I still think that's a specific bequest that would qualify for that exception.
Right. There's no provision in the trust itself that calls for that delay of time. It's just the trustee is not paid it in a timely manner.
Yeah. So I would not have that carry out.
Yes.
D&I. Somebody asked, why can't you accrue tax prep fees on the final return? Well, if you're an accrual method taxpayer, you can. So I haven't seen any trusts yet that are on the accrual method, but if you want to adopt that for your accounting method, then good luck. So then the question was, do you have a rule of thumb for how much or what percentage to hold in reserve, and how long should it be held? Well, the last answer is really easy, until the liabilities get resolved. And that may take several years before the liabilities get resolved. Now, how much to hold in reserve, I think it really all depends on the risks that you have. If I have an estate tax return that has marketable securities on it, and there's not much for the IRS to audit, then I might not hold a ton in reserve. But if I have closely held businesses coming out the wazoo, and I have all kinds of aggressive tax positions that the decedent was taking on his income tax returns, then I'm going to want to have a pretty hefty reserve. So do you have anything more to add to that, Laura?
No, I just think, you mentioned too that, typically we would move that reserve into a non-interest bearing account so that we don't continuously have income tax returns due. So at what point do you think it's, is the reserve too large to hold it in a non-interest bearing account and cut off those continuous income tax returns versus how much do you really need to reserve from a practical level, again, based on the risks that you have in that particular trust or estate. So I think it's a sort of a case by case basis as opposed to a rule of thumb necessarily.
We're going to stay on to answer some more questions, but we have reached the end of the time for those of you who do want to leave. And again, those of you who want to leave now, you can go ahead, but please complete and submit the survey that will display at the conclusion of the webinar. Okay, so we had a question about post-termination interest and dividends. Can you do some kind of a nominee 1099 from the closed trust to the beneficiaries as a potential solution? Well, again, that really is, you're doing reporting. So, I'm not sure that I'd be, thrilled about that, but I mean, technically, I suppose you could do something like that. I haven't really.
I've never done that.
Run across, right? Yeah, we really haven't thought about that. So, all right. Let's see what else we had here. If a living trust owned S Corp stock and the owner dies, is there 2 years to distribute the stock to the beneficiaries? And generally the answer is yes, but you can also, Laura mentioned about the Code Section 645 election, to treat the trust as if it were an estate.
Right, which gives you a reasonable period of time to hold that, which is more flexible than a trust, but you still obviously need to be cognizant of that because a reasonable time doesn't mean indefinite period of time. So again, the 645 would give you some more flexibility there, but still something that you have to kind of keep track of and make sure that's getting out in a timely basis, and that the appropriate elections for obviously the downstream beneficiaries are being made or abided by.
But also 645 elections, you look at the regulations, or you could even really just look at the Form 8855, because that really has all the rules from the regulations plus administrative things in there for how long the 645 election can last. So when Laura mentioned about reasonable administration, that's assuming that you filed an estate tax return and you haven't heard back from the IRS yet, and the statute of limitations remains open. The other thing is, the IRS stopped issuing closing letters. The 645 election will terminate
12 months after the closing letter, right? But
right.
Now it's much more challenging to get a closing letter.
Or the other thing you can do is you can get a transcript,
right,
instead of getting a closing letter. And a transcript gives you the same level of protection from the IRS that a closing letter does, but a transcript does not trigger the end of the 645 election period. So people might want to consider doing the transcript instead of the closing letter. Okay. Somebody asked a question that they had a big 1231 gain in 2020. In 2022, they had to pay the buyer back $1 million because of an issue not resolved at the time of sale. And are they stuck with the capital loss? Might they be able to amend the prior return? Is another question I might ask. But the other thing is, there's the claim of right doctrine. I think it was Code Section 1341. But if you just look up claim of right as a specific phrase, you will see that somewhere in, I think, Roman numeral 2G something of my materials. And in fact, I did discuss a little bit of that in my newsletter about the fact that you may have postmortem things that will generate income tax benefits and how to preserve those. So take a look at that. Let's see. somebody was asking about conversion of trust to the B dot discussion, and I think if you can just go ahead and email me to follow up if you have further questions about how to do that. And I think that's really about it. Is there anything more here, Laura, that I didn't cover that you want to go over?
I didn't see anything else.
Okay. All right. Well, again, thank you everybody for participating. We hope to be able to have further contact with you during the course of the year. And certainly you're welcome to come back next year. And again, please be sure to complete and submit the survey that we'll display at the conclusion of the webinar. Thanks again.
Thank you.